Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, we are diving straight into one of the most volatile and frankly complex profiles in the microcap sector today, SKYQ Inc., ticker SKYQ. We've all watched the stock trade in this tight but just intensely active range, cycling, again and again between about 29 and 43 cents. It's defined almost entirely by extreme market mechanics, not any stable fundamental reality. So the central question here, it's really binary. Is this thing positioned for a speculative renaissance, driven by this new $100 million digital asset treasury? Or are the acute liquidity distress and the governance failures just signaling an inevitable rapid slide toward insolvency?
Well, let's re-examine that premise. Because when you look beyond the intraday noise and focus on the structural pressure points, the market's consensus, particularly among sophisticated players, is definitively bearish. I mean, that high short interest, it's fluctuating between, 13.5% and 14.3% of the float. That is not an accident. You combine that with the disastrous for-cause termination of their co-founder CEO, and it just signals a deep institutional belief in imminent failure. I just don't see a turnaround story here. This is a highly distressed company trying to use financial engineering as a final desperate life raft when the hull's already breached.
I see why you'd emphasize that conviction, but let me offer a very different read on the costs they are bearing for that belief. You cite the short interest as a sign of consensus, but consensus is expensive here. We are seeing annualized borrow fees spiking over 50%, even hitting 63%. Paying that much interest, that demonstrates extreme exposure. That level of cost, it signals two things. First, that the supply for borrowing is incredibly tight, which points to a thin effective float. And second, that short sellers are paying dearly for their position. And that is the textbook setup for a massive, mechanical short squeeze. The stock price today isn't reflecting financial health. It's reflecting the cost of borrowing stock from institutions that simply refuse to lend it out cheap.
The price is disconnected from reality, I'll grant you that. But I'd argue that disconnection runs in the opposite direction. You're claiming the current valuation is too low because of the underlying asset base.
Precisely. The whole framework for a speculative renaissance is built on those underlying industrial assets. SKYQ controls the Forlin refinery in Nevada, and it holds significant Utah bitumen leases. These are tangible physical assets, real industrial capital that provide a theoretical floor value to the company. The market cap should reflect that. And when you compare SKQ's valuation to a peer like, say, Blue Dolphin Energy, which has a functioning refinery, SKQ appears fundamentally undervalued because the market is only pricing in distress and ignoring the asset base completely.
But the assets are utterly illiquid, and they're non-operational in any meaningful sense right now. A theoretical asset floor only matters if you have the working capital to maintain and actually monetize those assets. And this is where the financial reality just becomes brutal.
Which brings us to the strategic pivot. I argue the pivot to the digital asset treasury, the DAT, isn't reckless at all. It's a necessary, innovative maneuver. They need about $100 million in working capital to execute on their stalled asphalt recycling technology and the facility turnarounds. Traditional banking avenues are, they're completely closed off to a company with this kind of balance sheet. So tokenizing the inherent value of those illiquid assets, like future refinery production, for example, is really the only creative method left to unlock that trapped value and raise the capital they need.
Basic, unforgiving arithmetic. Let me just detail the devastating financial facts. As of September 30th, 2025, SKQ reported cash of only $362,517. Okay? Now, contrast that with their quarterly net loss, their burn rate, of $3.79 million. That's roughly $1.26 million lost per month. Simple math confirms they cannot cover a single month of operational expenses, not payroll, not capital expenditures, nothing, without immediate and continuous capital infusion, and often on predatory terms.
But that calculation supports the necessity of the DAT. It is the urgent need for non-dilutive, non-traditional capital that justifies taking the risk of this pivot.
But it solves today's problem, by structurally sacrificing tomorrow's equity value. And that brings us to the inherent flaw in their financing: their reliance on convertible notes and warrants. It's a machine for continuous, devastating dilution. Any price rally, any speculative bump you hope for from a debt announcement will be instantly capped and reversed by these instruments. The note holders just convert debt to equity at a massive discount and sell immediately into any strength. This mechanism, it's often called the death spiral, and it ensures that regardless of any good news, upward stock movement is just met with an immediate, self-inflicted wave of supply that crushes the price.
That's a compelling point about the dilution, and I agree it's a temporary reality of distressed financing. But I would frame it as the cost of survival. It's necessary to bridge the gap until their proprietary waste asphalt shingle technology, their WAS tech, can be scaled and the Foreland refinery turnarounds are done. That would significantly improve cash flow. The market has to see the forest for the trees here.
But the auditor sees the fire, not the forest. Their own SEC filings contain an explicit going concern qualification. And for anyone listening, that is not a minor footnote. It's a professional accounting judgment stating there is substantial doubt that the company can continue as an operational entity for the next 12 months. That qualification acts as a siren for potential bankruptcy. It slams the door on almost all traditional financing. It makes any fundamental investment case impossible to justify because you are investing in equity that their own auditors believe will soon be worthless. The $100 million DAT plan isn't a solution. It's a Hail Mary from a ship that's already sinking.
I think that's overly fatalistic. The DAT is the key to escaping that qualification, which I think brings us to our first core contention: the strategic validity and the execution risk of this digital asset treasury.
Agreed. I challenge the entire premise. Raising $100 million through tokenization exhibits what I'd call strategic dissonance. The company's core competency is industrial asphalt recycling, refining. The date effort requires them to suddenly pivot into high-level, complex digital securities issuance and compliance. I mean, what does tokenizing oil reserves have to do with efficiently running an asphalt recycling operation? This move looks structurally identical to past examples of failing microcaps just chasing buzzwords, and it introduces massive, unnecessary regulatory exposure.
I disagree that it's unnecessary. If traditional capital won't fund the maintenance required to keep the industrial assets viable, then this risk is essential for survival. And furthermore, it isn't a random pivot. It's a direct attempt to monetize assets that are currently illiquid. And let's talk about the WAS technology for a moment. This is a proprietary process. It allows them to efficiently recycle waste asphalt shingles into components for new asphalt, which dramatically lowers their costs and gives them a unique market advantage. Scaling that requires significant capex, which they simply cannot raise conventionally.
But the risk they're inviting is completely disproportionate to the potential reward, particularly on the compliance side. Let's be specific. They risk being classified as an investment company under the Investment Company Act of 1940 if their principal assets or revenue start to skew toward holding securities, which these digital tokens would certainly qualify as. The consequences of that classification are immense. It forces them into this crippling regulatory structure designed for large mutual funds, not microcap energy refiners.
And I'm not convinced by that line of reasoning because it ignores the execution strategy they've announced. The company is actively partnering with established blockchain firms like Continuum Network to handle the technical and compliance aspects. This isn't management just throwing darts at a board. It demonstrates an outsourced, tangible strategy to secure capital that traditional banking has denied them. They are attempting to compartmentalize the regulatory risk by relying on expert partners.
You can't outsource the ultimate responsibility for compliance. If the SEC determines that the tokens they're selling are unregistered securities, the company and its executives will bear the brunt of that. Are they equipped to navigate that compliance labyrinth while simultaneously struggling to manage refinery maintenance? I would argue the answer is emphatically no, especially given the history of the management team. Which brings us to our second contention: governance stability.
The governance changes were certainly tumultuous, but I would argue they were decisive.
They were catastrophic.
This governance crisis is too severe to just be framed as a decisive restructuring. The for-cause termination of co-founder and CEO David SKYQ in August 2025 suggests serious internal malfeasance or a breach of fiduciary duty. I mean, that's the kind of corporate action that completely erodes investor confidence regardless of the merits of the assets. You cannot execute a highly sophisticated, high-risk financial pivot without a clean, stable management structure.
But the board recognized the need for a change and took aggressive action to excise that internal failure. That's a positive sign of accountability, not a sign of terminal decline.
But look at the replacement. Interim CEO Marcus Lown carries his own complex regulatory history. We are talking about a 2013 FINRA suspension for failing to disclose outside business activities. That is a breach of compliance standards in a regulated industry. So in a situation where SKYQ is immediately entering the hyper-regulated digital assets space, where disclosure and compliance are paramount, placing an executive with a history of non-compliance at the helm just compounds the key person risk exponentially. If the SEC looks closely at the data initiative, Lown's history provides an immediate red flag.
I see the historical context, but I believe the board has worked to mitigate that. The governance changes, while traumatic, do demonstrate a commitment to shoring up internal controls. And more importantly, they've tried to stabilize their financial credibility by appointing Leo Womack, a CPA veteran with deep experience in energy accounting. Womack is a recognized stabilizing force intended specifically to reassure the market and tighten financial controls. Arguing that SKYQ's personal share sales after his departure dictates the future value of the physical assets, that's just noise. The refinery and the leases are what matter, and those are now managed by a board focused on solvency.
The board may be focused on solvency, but they're fighting gravity. The cash flow to sustain the physical assets simply does not exist. And that brings us right back to the most technical immediate risk factor, the rationality of the short position. You argue the technical setup suggests a massive squeeze. I maintain the shorts are rational actors engaging in clear-cut insolvency arbitrage.
Okay, let's focus on the technical setup, because this is where market mechanics can override the fundamentals. We have high short volume, and critically, nearly half, 47.5%, of that volume is occurring off-exchange in dark pools. This suggests concerted, aggressive selling that's designed to suppress the price without hitting the open tape, combined with that extremely thin effective float. This creates the perfect mechanical environment for a price spike, driven by retail speculation or institutional buying, regardless of the fundamentals. The fact that the borrow fee is over 50% forces shorts into an impossible mathematical corner if the stock fails to collapse immediately. They are paying an exorbitant price every single day for their conviction.
And that is the very definition of their high conviction. They are acting rationally despite the high cost. The high borrow rate simply reflects their belief that the company will file for Chapter 11 bankruptcy, where equity holders get zero faster than the 50+% interest rate costs them. They anticipate the continued issuance of toxic financing, those death spiral notes we talked about, which they are front-running. This is essentially a timing game. They're betting that the equity value will be wiped out within months.
But they're overlooking the liquidity vacuum. The effective flow is so tightly held that any concentrated retail buying can cause a disproportionate price increase, a liquidity spike. If they are paying 50% to borrow and the stock spikes 40% in a week because of date news, they are forced to cover to mitigate unlimited loss. They are trapped between paying that interest and facing catastrophic loss if a squeeze hits. Their technical risk is profound, even if their fundamental thesis that the company is doomed is sound.
That technical risk is balanced against the certainty of $362,000 in cash against a $3.79 million quarterly burn. The certainty of insolvency, which is a structural guarantee given their reliance on toxic financing, it outweighs the volatility of a short squeeze for any serious institutional short. They are betting on the arithmetic of distress. If the company must raise money every 30 days just to keep the lights on, and that money comes from dilutive notes, they're betting that the dilution will accelerate the timeline to zero faster than the borrow costs pile up.
But the whole premise of my argument is that financial innovation, specifically the $100 million DAT, bypasses that arithmetic
long enough to realize the industrial value of the assets. They are attempting to raise non-dilutive capital backed by resource security, not equity. If they're successful, that capital injection resolves the immediate liquidity crisis, which is the sole driver of the short seller's confidence.
That assumes flawless execution in two completely distinct, highly regulated sectors, oil refining and digital securities, by a management team that just went through catastrophic upheaval and includes individuals with histories of regulatory noncompliance. The odds of that succeeding are, well, they're astronomically low. The risk-adjusted return here points squarely toward insolvency.
It is the ultimate high-risk, high-reward proposition that defines this entire space. The market is currently offering a chance to bet on audacious financial engineering against immediate financial ruin.
And I maintain that it is catastrophic risk defined by negative operational cash flow, making the equity uninvestable.
Well, this discussion has certainly illuminated the deeply conflicted profile of SKYQ.
Absolutely. I think we've effectively synthesized the core disagreement here. One side, which I represent, believes the structural financing flaws and the acute financial reality that cash reserves are exhausted monthly make the company fundamentally uninvestable. It's going to result in inevitable equity dilution or total loss. The shorts are acting rationally.
And I assert that the tangible industrial assets, the refinery, the leases, combined with the immense speculative power of that $100 million debt initiative, create a unique, high-risk, high-reward trading opportunity. The technical setup with the dark pool volume and the thin float makes the stock ripe for a mechanical price spike. So the potential upside exists if the company can successfully raise even a fraction of that $100 million, potentially offering a valuation disconnect that rewards extreme risk tolerance.
Well, I have to reiterate that the immediate existential threat, the $362,000 in cash against the $1.26 million monthly burn, makes the company's future conditional on surviving the next few weeks, irrespective of any long-term vision, and the governance instability only increases the likelihood of an immediate misstep.
It's clear that SKYQ's profile is defined by this intersection of a fundamental industrial distress and intense, speculative market mechanics. Understanding both the certainty of the financial arithmetic and the volatility of the short trade is essential for anyone following this.
Indeed, there is certainly much more to explore in the interplay between their physical assets and their very ambitious and very risky digital engineering strategy.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.